The goal at this level is to achieve an annual return of 8 to 15%. That might sound modest, but remember, compound interest is the silent weapon of wealth. For example, if you invest about $2,000 at a 12% annual return, after 4 years you'll have nearly $3,200. If you continue to add regular monthly investments, that number could double or even triple. This is the sustainable wealth building method that truly wealthy people follow. The third layer, breakthrough. This is the part most young people get excited about. Business, crypto, forex, startups. This is where you can double or triple your capital in a single year. But it's also where you can lose everything just as fast. The key principle: only step into the third layer once your first and second layers are solid. That means you already have an emergency fund and a stable growth base. If not, you'll end up all in, driven by fear and emotion. And that's what kills most investors. Pause for a moment. I know many of you are thinking, I want to get rich fast. I don't want to go slow. My friend, we're now at the breakthrough layer of financial thinking. This is the level many people want to jump into right away, but it's also where 80–90% of new investors lose money. Remember this: breakthrough doesn't mean reckless. It means calculated risk, built on a foundation of safety from layers 1 and 2. If you don't have an emergency fund and a stable growth channel yet jump into business, crypto, or forex, you're not breaking through. You're gambling. So how do you break through the right way? There are 3 golden rules to remember. Rule 1. Use tuition money, not survival money. Tuition money is what you can afford to lose and still sleep well at night. Survival money is what pays your rent, food, and your children's education. Never use survival money to break through. If you have about $2,000, set aside $400 as your tuition fund for high-risk experiments. If you lose it, treat it as the cost of learning. If you win, it's a reward. Rule 2. Know the rules before you play. Don't wait for market chaos to decide whether to sell or hold. Set your principles in advance. For example, cut losses at 15%. Take partial profits at plus 30%. Those without discipline get greedy when they win and panic when they lose, ending up losing both ways. Rule 3. Invest in yourself before you invest in the market. Before putting money into stocks, spend time learning fundamental analysis. Before starting a business, learn marketing and management. Before entering crypto, study risk management and how to read white papers. Knowledge is your shield in this game. Pause again. Do you know why many people made huge profits in 2020–2021 from stocks and crypto, but lost everything in 2022? Not because they were stupid, but because they confused luck for skill. When the market turned, they didn't have the knowledge or discipline to protect their gains. We've now covered the 3 layers of financial mindset: protection, emergency fund, anti-inflation, capital preservation, growth, stable returns, disciplined accumulation, breakthrough, high risk, high reward, built on a safe foundation. If you build all 3, you won't panic when markets fluctuate. You'll know exactly where your money is, what it's for, and how much risk you're taking. This is the mindset that 95% of people never learn, which is why they keep chasing the crowd and keep losing money. Now let me show you 5 deadly financial mistakes most people make, and how to avoid them. Mistake 1. Letting money die in your bank account. Many people leave tens or hundreds of thousands of dollars sitting idle in a bank account, earning almost nothing. They think it's safe, but inflation eats it away daily. If inflation is 5% per year, $2,000 today will only be worth about $600 in 4 years. That means you're losing money silently without realizing it. Mistake 2. Investing based on emotion and the crowd. When others buy gold, they buy gold. When others rush into crypto, they go all in. When others sell, they panic and sell too. That's the fastest way to lose capital. Remember, when you see it on the news, the big wave has already passed. Winners are those who prepare early, not those who follow late. Mistake 3. Having no plan. Investing without a plan is like sailing without a map. You throw a little money here, a little there, and end up going nowhere. Always write down your goals. What's your 1-year goal? What's your 4-year goal? Which channels will you use and how much in each? When will you withdraw? When will you hold? Those with a plan can adjust. Those without one only panic. Mistake 4. Mixing investment and living funds. This trap bankrupts many people. They use living money, rent, food, tuition, for investing. When emergencies hit, they're forced to sell at a loss or borrow money, ending up with debt and loss. Always invest only with surplus funds. Mistake 5. Not learning continuously. Markets change every day. What's true today might be false tomorrow. If you stop learning, you'll be left behind. Investing is a lifelong game, and the one who keeps learning is the one who wins in the end. Pause and ask yourself, out of these 5 mistakes, how many are you making right now? If 2 or more, comment, I need to change. Because only when you admit it can you grow to the next level. My friend, I want you to remember one thing from Chapter 1. Money is less important than mindset. With the right mindset, $2,000 can be the start of a strong financial journey. With the wrong mindset, even $200,000 or $500,000 will eventually disappear. Chapter 2. The formula to multiply your capital. 20 times in 4 years. You have about $2,000, and your goal is $40,000 after 4 years. Sounds big? Let's break it down so you can see it's completely realistic. From $2,000 to $40,000 means multiplying your capital 20 times. How? 2 main factors: annual growth rate, continuous reinvestment, the core of compound interest. To reach 20x growth in 4 years, you need about 82% annual growth. Example growth path: year 1, $2,000. 3,600 year 2, 3,600. $6,600 year 3, $6,600. $12,000 year. $12,000, $22,000. That's only through compounding, but we're not stopping there. You'll also add fresh capital each month from your income. Let's say $200 a month or $2,400 per year. Over 4 years, that's $9,600 of new investment. Combined with compounding, you can easily surpass $40,000. The key: combine growth of old capital with consistent new contributions. That's what the rich do. They don't just let their money grow. They fuel the machine constantly. Let's see a specific example. Year 1. Start with $2,000. Invest safely, stocks or small business, and target 40% growth. End of year, $2,800. Add $2,400 from savings. Total $5,200. Year 2. Grow by 50%, $7,800. Add another $2,400. Total $10,200. Year 3. Grow by 60%, $16,300. Add $2,400. Total $18,700 is year 4. Push for 80% growth, $33,600. Add the final $2,400. Total $36,000, $40,000 range. That's how you get there, through compound returns, discipline, and consistent reinvestment. Pause and ask yourself, what have you done with your money in the last 4 years? Have you let compound interest work for you? Or have you spent everything as soon as it came? If not yet, and comment, I'll start now. Make that commitment today. One last note, don't confuse theory with reality. In real life, some years you'll earn more, some less, some even lose. But if you stay disciplined and keep adding capital, you'll still reach the finish line. This formula isn't for the lazy. It's for those who understand that wealth doesn't come from luck, but from clear plans and consistent action. Remember this: $2,000 plus disciplined investing, plus $200 monthly contributions, plus compound interest, $40,000 in 4 years. That's not a dream, it's mathematics. Now let's go deeper into what you should do in year 1, which channels to choose, and how to allocate your funds to achieve that growth rate. Year 1. Foundation building. You have about $2,000. The biggest mistake would be rushing into high-risk investments hoping to double quickly. Your mission in year 1 is to build a strong foundation and learn money management. First, set aside $400 as your emergency fund. Money you can't touch unless it's a true crisis. Then, take the remaining $1,600 and allocate as follows: $800 into safe instruments like short-term deposits or bond funds. $800 goes into growth channels like ETFs or blue-chip stocks. Throughout the first year, your goal isn't huge profits but learning patience. Assuming an average return of 30–40% for the growth portion, you could finish the year with around $2,600. But what's more important is that you've built the habit of adding $200 per month from your income to your investment fund. After 12 months, you've added about $2,400, bringing your total capital to around $5,000. Year 1 is also when you should invest in yourself. Read at least 12 books on personal finance. Join 1 to 2 courses on stock investing, online business, or money management. Money spent on education brings the highest return rate. Stop and think. If you can't stay disciplined saving $200 per month, you'll never be disciplined saving $2,000 per month. Year 1 isn't for making a fortune, but for building your financial muscle. Year 2. Acceleration. Entering the second year, you have about $5,000. Now it's time to diversify. Instead of keeping too much in savings, you could allocate 30% to stocks, 20% to ETFs, 10% to a small online business, and the rest to bonds or gold. Your goal is to grow by 50%, turning $5,000 into about $7,500. Add another $2,400 in monthly savings, and you'll end the year with around $10,000. Year 2 is when you start testing small projects, online sales, partnering on small ventures, running a tiny coffee stall, or importing a trial batch of products. It's not just investing, but learning entrepreneurship. You might gain a little or lose a little, but the experience is priceless. A reminder, don't fear mistakes. Small losses are tuition fees. What matters is the lesson. Year 3, the leap. With around $10,000, you have more options. Now you must pick 1-2 of the most effective channels from the past 2 years and focus. If stocks performed well, increase your stake. If online business brought profits, expand it. If ETFs proved steady, keep contributing regularly. The goal for year 3 is 60% growth, bringing you to about $16,000. Add your new $2,400 savings and you'll reach around $18,000. This is when you must learn reinvestment. Don't spend profits. Recycle them into capital. That's how the wealthy grow. Profits breed capital, and capital breeds more profits. Year 4. Breakthrough. With about $18,000, you're nearly halfway there. Now focus entirely on your best performing 2 channels and aim for 80% growth. If you achieve that, your capital becomes $32,000. And adding your final $2,400 savings gets you to about $35,000. Nearly $40,000. And with a bit of luck on 1 or 2 good deals, you could surpass the $40,000 mark. Remember, breakthrough doesn't mean recklessness. It means focusing resources on what's proven to work. If stocks and online business have been your top performers, double down on them. So from an initial $2,000, plus $9,600 in added capital, compound interest and steady growth, you can realistically reach $40,000 in 4 years. This isn't a wild promise. It's a clear path backed by math and discipline. Are you ready to write your own 4-year plan? If you are, say it out loud. I'm starting now. At the end of the first year, your total capital is around $5,000 to $5,200. This number isn't huge, but what truly matters is that you've built a financial habit, and that's the real power that will carry you far. Step 2. Acceleration and experimentation. Entering the second year, you have about $5,200. This is the time to expand and diversify. 30% of your capital can go into individual stocks, 20% into ETFs, 20% in safe assets like bonds, 10% in gold, and the remaining 20% for small business experiments. In your second year, you must dare to test small projects to learn how business works. For example, spend $800 to import a batch of phone accessories and sell them on Shopee, or invest $400 with friends to start a takeaway coffee cart. The goal isn't big profits, but to learn how to run a real operation: purchasing, selling, managing costs, and marketing. These lessons are priceless because whether you make a little profit or a small loss, you're buying experience no school can teach. If done right, you could achieve an average 50% profit, turning $5,200 into about $7,800. Add another $2,400 from your income, and you'll finish the year with around $10,000. Now you begin to feel the power of compound growth combined with consistent capital additions. Step 3. Focus and scaling up. With $10,000, you're no longer a small investor. This is the time to select 1 or 2 of the most effective channels and concentrate your capital. After 2 years of experimentation, you'll know the answers. How much did your stocks return? Is online business viable? Are your ETFs stable enough? If online business brings steady profits, you can raise investment from $800 to $3,200 to expand your product line. If your stocks performed well, increase your exposure to blue chips or ETFs. The principle is to concentrate resources on what works best, instead of spreading them too thin. The goal in year 3 is 60% growth, turning $10,000 into $16,000. Add another $2,400 in savings, and you'll end the year with about $18,400. This is the stage where you must learn how to reinvest profits. When your online business earns $800, use that profit to buy more inventory and scale up. When your stocks yield 15%, don't withdraw. Let the compounding work. This is how the wealthy turn profits into assets, not into liabilities. Step 4. Breakthrough to the $40,000 mark. With $18,400, you've completed 3/4 of the journey. Now it's time to go all in strategically for a breakthrough. Pick your 2 strongest channels, for example, stocks and online business, and allocate most of your funds there. 12,000 in stocks, 6,000 in business, 400 as an emergency reserve. Your goal in year 4 is 70–80% growth. If you achieve this, your capital will rise to about $32,800. Add your new $2,400 savings, and you'll have around $36,000. And if you catch a few winning opportunities, a strong performing stock or a viral online product reaching $40,000 is entirely within reach. The key point of the N-Bull strategy is focused, selective breakthroughs. Don't chase new, untested opportunities. Don't get distracted by short-term hype. Put all your energy into what's already proven to work. That's the surest path to the finish line. After 4 years, when you look back, you'll see a tremendous transformation, not just from $2,000 to $40,000, but also in your mindset, discipline, and experience. You'll have a financial foundation and an investor's mindset that will continue to multiply, taking you from $40,000 to $200,000, then $400,000, and eventually to financial freedom. Now, write down your personal 4-year plan. What will you do each year? How will you allocate capital? What new skills will you learn? Then publicly commit by saying, I will turn $2,000 into $40,000. That's your promise, to yourself and to your community. At the end of the first year, your total capital is around $5,000 to $5,200. This number isn't huge, but what truly matters is that you've built a financial habit, and that's the real power that will carry you far. Step 2. Acceleration and experimentation. Entering the second year, you have about $5,200. This is the time to expand and diversify. 30% of your capital can go into individual stocks, 20% into ETFs, 20% in safe assets like bonds, 10% in gold, and the remaining 20% for small business experiments. In your second year, you must dare to test small projects to learn how business works. For example, spend $800 to import a batch of phone accessories and sell them on Shopee, or invest $400 with friends to start a takeaway coffee cart. The goal isn't big profits, but to learn how to run a real operation: purchasing, selling, managing costs, and marketing. These lessons are priceless because whether you make a little profit or a small loss, you're buying experience no school can teach. If done right, you could achieve an average 50% profit, turning $5,200 into about $7,800. Add another $2,400 from your income, and you'll finish the year with around $10,000. Now you begin to feel the power of compound growth combined with consistent capital additions. Step 3. Focus and scaling up. With $10,000, you're no longer a small investor. This is the time to select 1 or 2 of the most effective channels and concentrate your capital. After 2 years of experimentation, you'll know the answers. How much did your stocks return? Is online business viable? Are your ETFs stable enough? If online business brings steady profits, you can raise investment from $800 to $3,200 to expand your product line. If your stocks performed well, increase your exposure to blue chips or ETFs. The principle is to concentrate resources on what works best, instead of spreading them too thin. The goal in year 3 is 60% growth, turning $10,000 into $16,000. Add another $2,400 in savings, and you'll end the year with about $18,400. This is the stage where you must learn how to reinvest profits. When your online business earns $800, use that profit to buy more inventory and scale up. When your stocks yield 15%, don't withdraw. Let the compounding work. This is how the wealthy turn profits into assets, not into liabilities. Step 4. Breakthrough to the $40,000 mark. With $18,400, you've completed 3/4 of the journey. Now it's time to go all in strategically for a breakthrough. Pick your 2 strongest channels, for example, stocks and online business, and allocate most of your funds there. 12,000 in stocks, 6,000 in business, 400 as an emergency reserve. Your goal in year 4 is 70–80% growth. If you achieve this, your capital will rise to about $32,800. Add your new $2,400 savings, and you'll have around $36,000. And if you catch a few winning opportunities, a strong performing stock or a viral online product reaching $40,000 is entirely within reach. The key point of the N-Bull strategy is focused, selective breakthroughs. Don't chase new, untested opportunities. Don't get distracted by short-term hype. Put all your energy into what's already proven to work. That's the surest path to the finish line. After 4 years, when you look back, you'll see a tremendous transformation, not just from $2,000 to $40,000, but also in your mindset, discipline, and experience. You'll have a financial foundation and an investor's mindset that will continue to multiply, taking you from $40,000 to $200,000, then $400,000, and eventually to financial freedom. Now, write down your personal 4-year plan. What will you do each year? How will you allocate capital? What new skills will you learn? Then publicly commit by saying, I will turn $2,000 into $40,000. That's your promise, to yourself and to your community. Risk 2, partnership. Risk you contribute capital with friends but have no clear contract. When losses happen, you argue. When profits come, you fight over them. Or worse, you get dragged into disguised pyramid schemes. This is a very common risk. Prevention. Only invest when there's a clear legal agreement and never put money into something you don't fully understand. And always remember, don't let emotions override logic when it comes to money. Risk 3. Psychological risk. This is the number one enemy. When the market rises, you become greedy and want more. When the market drops, you panic and sell off. The result? You buy at the top and sell at the bottom, the exact pattern that causes 90% of investors to lose money. Prevention. Write down your rules and commit to them. For example, cut losses if you're down 15%. Take partial profits if you're up 30%. Never let emotions make decisions in place of discipline. Risk 4. Overspending. Many investors make a $2,000 profit and then spend it all, buying a new phone or a motorbike. If profits are not reinvested, your journey ends halfway. Prevention. Commit that during the first 4 years, 100% of profits must be reinvested. Only after reaching the $40,000 milestone can you reward yourself with a small portion of the gains. Risk 5. Inflation and crisis money loses value over time. A sudden event, like a pandemic or economic crisis, can overturn all your plans. Prevention. In addition to diversification, always have defensive channels such as gold or government bonds. These are safe havens when markets swing violently. If you think you'll never face risks, you're already wrong. The difference between the rich and the poor is that the rich always prepare for the worst-case scenario, not just dream of the best one. Remember, protecting your capital is more important than making profits. If you lose 50%, you need a 100% gain just to break even. If you lose 80%, you need a 400% gain to recover. That's why capital preservation is the number one priority. To manage risk effectively, follow 3 core rules. Never invest more than 10 to 20% of your capital in any high-risk channel. Always keep an emergency fund covering 3 to 6 months of living expenses. Regularly review your portfolio. Cut weak performers, add to strong ones. Dear friend, risk isn't something to fear, it's something to manage. When you're well prepared, risk becomes the ladder that helps you climb higher. Chapter 5. Case Studies and Inspiration. Dear friend, theory means little without real examples. To show that turning $2,000 into $40,000 is possible, here are several real-life stories, some of success, others of failure. These will serve as vivid lessons for you to remember deeply. Case Study 1. From office worker to online shop owner Emily. A 25-year-old office worker earning $320 a month in 2020 saved $2,000. Instead of putting it in the bank, she used $400 for an online sales course, $200 to buy organic cosmetics, and kept $400 for emergencies. At first, she only sold to friends and co-workers, but through persistence, learning ads and TikTok marketing, her shop began generating steady profits after 6 months. She reinvested every profit instead of spending it. After 4 years, her store's monthly revenue reached thousands of dollars, and total accumulated profit exceeded $40,000. From an office worker, Emily became a successful online business owner. Lesson: learn, start small, stay consistent, and reinvest. The true formula for success. Case Study 2. The patient stock investor Michael, 28, a software engineer, saved $2,000 and chose to invest in the stock market. Instead of chasing short-term waves, he bought 2 blue-chip stocks and 1 ETF, adding $200 monthly. During downturns, he didn't panic sell, but saw them as buying opportunities. After 4 years, through compound returns and steady contributions, his portfolio exceeded $44,000. He didn't become rich overnight, but he proved that discipline and patience deliver results. Lesson: compound interest only works when you let time do the work. Case Study 3. Losing everything by following the crowd. Kevin, 30, heard friends say a certain coin would grow 10x. He poured his entire $2,000 into it. The price doubled in 2 weeks, but he didn't sell, expecting more. A few months later, it crashed 90%, wiping out almost everything. He panic sold and lost his entire capital. Lesson: without research and risk management, investing is just gambling. Case Study 4. Smart partnership. Sophia, 32, had $2,000. She didn't want to run a business alone, so she partnered with a friend to open a milk tea shop. However, she insisted on a clear contract, contributing 20% capital for 20% profit. With rights to check financials, the shop grew well, earning $200 profit monthly, giving Sophia $240 passive income each month. After 3 years, she recovered her initial capital, and profits kept rising. After 4 years, her total return exceeded $20,000. Lesson: joint ventures can be highly profitable if the partnership is transparent. Case Study 5. Investing in yourself. Daniel, 27, used $2,000 to study programming and English. After 2 years, he landed a new job, tripling his income. Over 4 years, his total accumulated income exceeded $40,000, not through trading or business, but through personal growth. Lesson: investing in yourself offers the highest ROI and never loses value. As you can see, there are many paths from $2,000 to $40,000. The successful ones share 3 traits: planning discipline. Continuous learning. Failures usually come from impatience, herd mentality, or poor risk management. So ask yourself, do you want to be like Emily, Michael, Sophia, or Daniel? Or like Kevin? Your answer will decide how you act after reading this. Final chapter. Start now, dear friend. We've walked through the full journey: financial mindset, the 20x compounding formula, yearly roadmap, risk management, and real case studies. It all comes down to one question: what will you do with your $2,000? It may be small for some, but for those who use it wisely, it's the seed of financial freedom. Remember, don't let your money die. Inflation eats it daily. Don't follow the crowd, most lose. Don't forget to reinvest. Compounding is the magic key. Don't stop learning. The best investment is in yourself. If you're serious, write your 4-year plan now. Year by year, month by month, how much you'll invest and where. When you write it down, it becomes a plan. When you act, it becomes reality. Time will pass whether you act or not, so why not make it work for you? I'm not promising overnight wealth, only a realistic path where discipline and patience can turn small capital into freedom. Start today, and your $2,000 could be the seed that grows into $40,000, $200,000, even $400,000 in the future. Comment your commitment. I'll start today. That's your promise to yourself and your financial future. Don't forget to like this video, subscribe to Bedtime Story Tales, and turn on the notification bell, because in upcoming videos, I'll share strategies to go from $40,000 to $200,000, $400,000, and eventually, true financial freedom. Your financial future begins with this decision. Will you let your $2,000 sleep or make it grow? The choice is yours. Thank you for staying until the end. I'm your name from Bedtime Story Tales. See you in the next video.